Hello, thank you for coming. Just a little bit longer. Good morning. Thank you all for joining us. Fabulous. Well, I'm going to go ahead and get started this morning. Thank you once again for joining us. My name is Caitlin. I'm the events coordinator for Sensiba San Filippo. I am going to go through a few housekeeping items before we get started with our content for the day. First off is we are recording this session, and both the slide deck and the recording will be provided to you after the event. Please utilize the Q&A box so presenters can answer any questions you may have. If you have a very specific question or if your question is not answered during the webinar, please reach out to your SSF representative. You may email info@ssfllp.com or respond to the follow-up email that you will be receiving. We are offering CPE for this session, and to qualify, you'll have to remain on the meeting for 50 minutes and answer the polling questions as they come up. We do have a lovely disclaimer for you, just stating that this is not end all be all and would be a lot more specific if you guys talk to an SSF representative. Our presenters for the day, they're looking forward to presenting to you all. The contact information is also at the end of this PowerPoint. So if you don't get it now and you want it, it will be available later. Our agenda for today, we will start off with some R&D credit in our R&D expense capitalization, lease accounting update, sustainability, and international tax overview. And with that being said, our first presenter is Colmar.
Hello, thank you, Caitlin. Appreciate that. I'm happy to be here with everybody this morning to discuss the R&D tax credit in a bit of detail and talk about some expected updates on that front for 2023. And then we'll also get into the mandatory R&D expense capitalization requirements that have gone into effect for 2022. We'll cover those in as much detail as I can in the little bit of limited time that I have. So there may be questions afterwards. Definitely feel free to follow up on it. To start out, I just want to orient everybody to the R&D tax credit. If you don't know much about it or need a refresher, here we go. And I want to define some terminology throughout these next couple of slides. I'll be talking about section 41 and I'll be talking about section 174. So section 41 is the research and development tax credit, and it has very well defined long-standing guidelines. Section 174, which I'll be discussing, has been around for a long time, but has not been defined quite as well, which we'll get into towards the end of this presentation. So section 174, the R&D tax credit, is a general business credit that is meant to incentivize product development as well as process development, and can amount to 6 to 12% or so of the qualifying expenditures back to the company as a credit. Most states or many states have some form of R&D tax credit. The state of California has about an equally as lucrative credit as the federal. So if you're doing your R&D in California, all things go according to plan, you should be able to receive about somewhere between 10 and 20% general business credit from those expenditures in the form of the R&D tax credit. The main requirement or the guidepost that we have to meet in order for something to be a section 41 R&D tax credit expense are laid out here in the middle of the slide. So any activity, the IRS's term is business component, right? You can think of that as a project. Any project needs to be scientific in nature. We need to demonstrate a process of experimentation. There needs to be technological uncertainty, and we need to show that it was for a permitted purpose. So making something faster, cheaper, better, improving function, quality, reliability. Those sorts of tangible, think back to the first bullet here, scientific in nature type of items. And then we attach the expenses and you're off to the races on the R&D tax credit. Also important to note at the bottom of the slide here, if you're a startup business, so you're in your first 5 years of operations with the revenue of your company below 5 million in the particular year, you can elect to offset up to $250,000 of payroll tax using the R&D tax credit in 2022. And then moving forward to 2023, they raised that threshold from a $250,000 limit as a startup business to offset payroll tax to $500,000. So that'll be one update that we will be looking to make sure we capitalize on in 2023. A quick overview here of the potentially eligible R&D tax credit expenses. So wages, supplies, contract research. We outline these in some detail here, and these will be available obviously in the slide deck. If you choose to download those, can look at more detail on those. We wanted to provide those to you. So what is the biggest change that we expect, right? I just mentioned the increase in the payroll tax offset for 2023, but the big change that we expect for 2023 is that the IRS is going to start requiring some additional disclosure when a taxpayer is filing the tax form that's associated with the R&D tax credit and the tax form that you fill out essentially to claim the R&D tax credit. So previously the form feels like a lot of other tax forms you might be familiar with. You put the numbers on there, it follows through the calculation, you get to a credit number at the end, and it flows on to a different form in the tax return. So the potential change underway that we think will take effect for 2023 is some additional disclosure to include things such as the 3 bullet points in the middle of this slide. First one is the number of business components. I mentioned earlier, business component is IRS shorthand for project. So, whenever we talk about a project or initiative at a company, the IRS calls it a business component. So those are the terms we talk in with the R&D tax credit. We think they're going to ask us to identify each business component and provide an explanation or a description of what that project or business component was. Right? We don't know the level of detail that'll be required, but some level of explanation in advance to the IRS. And then they're going to most likely ask us to provide a detailed breakdown by business component of the wages that were included, the supplies attributable to that business component, and the contract research expenses that may have been attributable to that business component. While the basics of this information have long been required to simply compute your R&D tax credit to begin with, I think the presentation of this information and the compilation of certain components of it are going to end up requiring a reasonably significant additional effort for many taxpayers to claim this credit and to satisfy the new expectations or the new requirements of the Form 6765 to file the credit. So those are all things to think about, right? When you're preparing for 2023, if you're not tracking projects directly, maybe not time directly, right? But if you're not keeping project descriptions or doing project write-ups as you go, a formalized kickoff to a project where you might write up the idea and why you're doing it, et cetera, now would be a good time to maybe just spend a little bit of time as you go through the year to document those projects and be ready for those additional disclosure requirements. So now moving on to the most exciting part of my time here is Section 174, Capitalization and Expense Amortization Requirements. So what is this? Well, the first thing you'll notice as I go through this slide is I'm not going to talk too much on this slide about what a 174 expense is. I'm going to talk to you about what is required to do with a 174 expense, and then in the next couple of slides we'll dig in a bit to what is a 174 expense. So in general, there was a change that was made in 2017 in the TCJA that would require companies beginning with tax years beginning after 12/31/2021 to capitalize and amortize their expenses that could be defined as Section 174 research and experimental expenditures. So previously, since the mid-50s, this was an election. It was not mandatory to capitalize your R&D expenditures. And therefore, really nobody did, because it's a much more preferential treatment to be able to take the deduction in the current year, right? Get the expenses for the effort, the expense that you expended, and keep on moving. So now the requirement is for tax year 2022 is that we need to quantify those expenditures and spread them out over a period of 5 years. Oh, by the way, there's a mid-year convention, so you'll really only get 10% of the deduction, or get to feel the benefit of 10% of that expense in the first year. And foreign research has a different period. That's a 15-year amortization period as well. So moving on to dig in a little bit more to what a 174 expense is, generally, the definition tracks pretty closely to Section 41, Research and Experimentation Tax Credit, though the definitions are broader in several ways. So one key takeaway might be that if you're calculating an R&D tax credit, Section 41, that could be a good place to start with quantifying your 174 expense. However, your 174 expense is certainly going to be a larger category of expense, right? Your 174 expense is always going to be a larger number than your Section 41 for several reasons we'll see on the next slide in a minute when we get there. So the other thing I want to highlight at the bottom of this slide is if you make this change, right, this change is not, I won't say it's not an election, because that means a very particular thing in tax, speak. But it's a requirement. So the IRS has decided to enable taxpayers to make this change in as easy way as possible. So for 2022, instead of filing a method election change because you're being required to do this, they're allowing a statement to be added to your tax return. So if you make the change in 2022, there's a little bit easier process to change that when you're filing your tax return. So next slide. And here we dig into some of the differences between Section 41 and Section 174. I noted that the 41 is a subset of 174. So you'll see on the first bullet here, taxable wages is a 41 expense. You take those same wages and you have to go to the gross wage, right? So that's almost always going to be a larger amount. So once you make those adjustments, you're going to end up with a larger bucket of expense. And then there are some other things that are required to be included as a 174 expense, some allocations for utilities, depreciation, I mentioned foreign research, all goes into buckets which create a larger category of expense. I'll note that we think and we hope that the IRS is going to provide a little bit more guidance on what they expect 174 expenses to be, how they'd like to see them presented, all those details which they have not clarified yet for us, sometime later in the quarter, early next quarter, in March or April of 2023. So with that, I appreciate everybody's time. We'll go back to Caitlin. She'll launch the polling question, and then we'll move to the next section.
Thank you, Cole. I just launched the question. We're going to give you guys some time to answer, and I will warn everyone before it is taken off the screen. I'm sorry. So the R&D question is, have you included Section 174 expense changes in your tax planning? I apologize. The answer options are yes, no, or not applicable. 80%. Few more seconds. All right, I'm going to close the poll in 3, 2, 1. Next up, we've got Joe talking about lease accounting.
Great. Thanks, Caitlin. Good morning, everyone. And thank you, Cole, for those insights into the latest R&D credit and R&D capitalization requirements for tax purposes. This morning, I'm going to be presenting a very brief overview of some of the topics related to the new lease accounting standard under ASC 842. Okay, next slide, please. Thank you. So here is our agenda. The topics I have here include an overview of the new standard, 6 steps to success for implementation, discount rate options for consideration, as well as a high-level overview of the changes to the financial statement presentation, accounting policy adoption considerations, and footnote disclosure requirements for lessees. We will finish with an introduction to our service offerings available as related to the new lease standard. Okay, next slide, please. So in terms of effective dates, if you're not aware, maybe you've been living under a rock or on a beautiful beach somewhere, you're not concerned with accounting as of yet, but the effective date is now. For public companies, it was effective all the way back starting January 1st, 2019. It was delayed for private companies and nonprofit organizations, but for those private companies and nonprofits, the effective date is January 1st, 2022. So you're probably asking yourself, well, what the heck is happening? I'm already in February 2023. In theory, you should have been accounting for this new standard starting January 1st, 2022. Now, a lot of people really ask, why am I being required to do this? The overall goal of this new standard is to bring all of the operating leases that used to be maybe just disclosed in your financial statements onto the face of the balance sheet as an actual liability. So that's the biggest change you're going to see under this new standard. Okay, so moving on here on the next slide. So someone might even ask a simple question, what is a lease under this new standard? And there's kind of 2 concepts of importance that I've highlighted for you on this slide, really focusing around the idea of a contract. So a contract that a company enters into, it does need to be examined to determine if there is a lease or potentially even an embedded lease within that contract. One of the other key items is that it must be for a physical identified asset that is explicitly noted in that contract. Lessees must have the right to control the use of that underlying asset. And what is control? Well, that's defined as being able to take substantially all of the economic benefits of the asset through the lease term and also directing the use of said asset. So if you don't have both of those, control does not exist. You don't have a contract that qualifies as a lease under the new standard. And one more thing to highlight here is a lessor cannot substitute the asset. So if it's a homogeneous piece of equipment or something that can be readily replaced by the lessor, that wouldn't qualify as a lease under this new standard. So that's something to keep in mind as you're analyzing your leases. Okay, so next here, so what I have here, I'm calling this our 6 steps to success, alliteration for those who remember that from grammar school. I did include a link in our blog on this slide that goes in detail a lot more on what each of these steps include. But on a really high level, starting with things like reviewing your general ledger, looking for recurring payments that might qualify as a lease, creating an inventory or just a record of all your leases and contracts in one place to accumulate things like key terms, payment amounts, separating things like variable and fixed payments. That's another key thing we want to do because that does fall into the disclosures under the new standard. There are some things like considering policy elections, the election of practical expedience, evaluating contracts to determine proper classification for a finance lease or an operating lease. And really one of the biggest one is evaluating some of these financial statement adoption options. And I will actually go into that a little bit more detail on today's presentation as well. So really, I would really encourage you, once you get these slides, hit that link, go to the blog. You're going to get a lot of great tips on some of these areas here for those of you who may have not started with this new standard yet. Okay, so next we have discount rates. This is a really big part of the new standard because if you kind of think about how used to be called a capital lease, now it's called a financing lease, but really the idea of amortizing the present value of those leases over time based on an imputed interest rate, that was kind of a concept that used to apply only to those capital or financing leases as we call them now, but that's being brought on to operating leases now as well. So since we're going to have those operating lease liabilities on the balance sheet, they're kind of going to be accounted for in a similar manner to some of those historical capital leases that you used to work with in the past. So the first discount rate option is known as the implicit rate, or the IR. You can see the definition here on the slide. Now, in order to determine the implicit rate, the lessee does need to know some of the assumptions used by a lessor in pricing that lease they have, including things like the underlying fair market value of the asset under lease, the estimated useful life of that lease, and the residual value at the end of the lease, and any initial direct costs deferred by the lessor. Now, you're probably asking yourself, well, how am I going to calculate all that stuff or even obtain that information? It's very unlikely that the lessee is going to have access to all of that information, or even maybe have that implicit rate explicitly stated on a lease. So really what we're seeing is that information is really not available to lessees, and they're usually deferring to one of the other two options for their discount rate under practice. So let's take a look at those other two next. Okay, so can we go, perfect, next slide. So the second one here, it's called the incremental borrowing rate, or the IBR. I always like to start with a couple common myths about the IBR and how it's determined, because it's a little bit tricky. So what I'll kind of go into here is, let's say you had a piece of commercial real estate and you also had a copier lease. You would not be able to take one incremental borrowing rate that you've calculated and apply that to both that piece of real estate that you're leasing and that copier lease, because they're going to have different terms, different lives, et cetera. So you can't just pick one rate and say, I'm done. It's a little bit more complicated than that. There is a little bit relief for people who do elect to use the IBR. If you have something like a similar group of assets, let's say a vehicle fleet, you can apply one rate to all the assets in that fleet. It's called the portfolio approach. Under the new standard, you don't have to calculate a separate rate for each specific vehicle in that fleet, for example. So you do get a little bit of relief there. One thing that I will say is you need to be careful if you're using the IBR, because of course, under this new standard, the FASB didn't do us any favors by prescribing a particular method for actually estimating or calculating that IBR. It's up to the lessee to determine that. And there is a variety of methodologies in practice that you can use, but you have to consider a lot of factors, such as the maturity of the lease, the term of the lease, any collateral involved with the lease, things like the current economic environment and entity-specific credit risk factors of the lessee. That's a mouthful. So really you need to be careful when electing this rate and making sure that some of the assumptions and judgments used to calculate that rate are at least generally reasonable for the asset under lease. So continuing on with our incremental borrowing rate, I listed 3 examples here on how you could potentially start to determine what that rate might be. Some things you can use are either the rate on an existing debt facility you might have, borrowing rates of similar entities on the public debt market, or even a rate quoted by your lender. There's a little bit of nuance that goes into each of these items here, so we don't have time to go over these today, but if you do have questions on some of these options, please reach out and we'd be happy to guide you through some of this. Now, what I want to move on to next is the risk-free rate. I'm sorry, go back on that slide we were just on, sorry. The risk-free rate, it's a practical expedient that is allowable for private companies, and this is kind of what I call the golden key to this whole process, because it is going to save you tons of time determining your interest rate. It's going to be no judgment involved other than really the life of your lease. And it's based on the zero coupon US Treasury rates for the period of the lease. So to make things really simple, let's say you had a lease that starts on January 1st, 2022 and ends December 31st, 2025. That's a 3-year lease. What we're going to say is, what is my 3-year Treasury rate? Boom, that's my rate right there. So you can kind of stop right there. It makes things pretty simple for you. Now, one thing you do need to be careful about with this whole kind of discount rate consideration is, if you're choosing something like the risk-free rate, that's going to typically be a lower interest rate than potentially the incremental borrowing rate or the implicit rate, and that would have an effect on your present value calculation. So in theory, the incremental borrowing rate will typically result in a higher lease liability on your books compared to some of those other rates. But typically there isn't a big enough skew amongst those rates to have a real material effect on the balance sheet. But what we kind of always like to say as a caveat is, if you haven't talked to your banker about this new lease standard, just make sure that you take a couple minutes to meet with them and kind of go over some of these ideas, because it could affect covenants and things like that in the future. So moving on beyond that, a couple really quick things I just want to share with you here. You can kind of read through these on your own on the slides. Just a couple changes to what the balance sheet might look like under the new standard and what the income statement might look like under the new standard. The biggest change on the balance sheet side is you're going to have that new lease liability and also this kind of new term, which is called a right of use asset. That's going to kind of be the contra to that lease liability on your books. Next slide, please. Then just a quick update here on what your cash flow statement might look like. It's not a huge change. You're just going to have segregated between the financing lease components, if they exist for your company, and the operating lease components in different sections of that cash flow statement. I do have a little note here about some things about foreign currency presentation, but that's not as crucial a topic, I think, for us today. So I'm going to skip over that right there. And what I'm going to do is I'm going to move into the last couple slides here are just giving you a brief overview of some of the accounting policy adoption and election disclosures that you need to make and consider when you're adopting the new standard here. A lot of it really surrounds the ideas of how you're calculating some of these new items like the right of use asset or the lease liability, and some of the judgment or elections that go into those policies that a company may elect when they adopt. What else do we have here? So on the next two slides, again, I just thought I'd list some of the changes and new items you might see in the actual disclosure of your financial statement. So the first thing I was referencing on the previous slide would be kind of in your accounting policy section of your footnotes. These next two slides here go over some of the different types of information and disclosures you'd have to make in that actual footnote portion of your financial statements. And I would say the biggest thing to consider, if we can go to the next slide, please, is you're just going to want to make sure that you're tracking everything for operating and financing leases separately. They can all be in the same footnote, but we really want to make sure they're separately reported, because there is going to be different disclosure requirements and details for each of those types of leases. And again, I really want to stress that this is a lot of content to kind of absorb in 10 or 12 minutes. So please reach out with questions in the Q&A, or feel free to contact me directly from my contact information. And that actually leads me to our final slide on leases, is a quick recap. This standard is effective now. So if you haven't already adopted it and done your work, you're going to need to do that very soon. And really what I included here, which I think is very helpful, is a link to our landing page. It has tons of great information about lease accounting, a white paper on the new standard, some other YouTube videos that go into a little bit more in-depth analysis about the standard, as well as a place for you to put your contact information to sign up for a free 15-minute consultation on how we could potentially help you with this new standard. So that is all I have for you today on the new lease accounting standard. Next, we'll transition into another one of our wonderful polling questions.
Thanks, Joe. Polling question. I just launched it. So the question is, have you adopted the new lease accounting standard under ASC 842? The answer possibilities are yes, currently working through the adoption implementation, no, not yet, and what is ASC 842? Nice, we about 70% participated. Fabulous. So I'm going to close the poll in about 5 seconds. In 3, 2, 1. It looks like about 31% of you guys said yes, 17 said currently working, 50% said no, not yet, and 2% said what is ASC 842. Moving on, we will get into sustainability and with Jennifer Quintero.
Hello, everyone. Thank you, Kate, and thank you, Joe, for great information about leasing. So I'm going to dig into all of the sustainability and ESG stuff that's coming down the pipeline. It's no longer a nice to have really to do this work. It's more going to be a need to have coming really, really soon. The good news is that we have services that we can help you through this process so you don't have to tackle it alone. So Kate, can you give me your next slide, please? So first, I'm going to go through and we're going to touch upon some of the things that have been coming out recently, one of which is the SEC rules from the federal level. Now, these rules are for public companies. However, there is a portion of the reporting that they're going to have to do, that they're going to have to dig down into their supply chain. And who's in their supply chain but small and medium privately held companies. So a lot of small to medium privately held companies are going to need to have this data if they want to maintain the relationships with their suppliers. So it would behoove you to start calculating these things now to have those numbers prepared for when these public companies are going to start reaching down and asking for these numbers. We do expect the final ruling for this to come in April. And April, spring, there's been some pushback from the conservatives, but we do expect stuff to pass in spring of this year. And then similarly proposed coming is going to be human capital disclosures. So our financial statements are going to be full ESG documents. You're going to have the environmental climate disclosures, you're going to have the human capital social disclosures, and then you're going to have your finances. So it's going to be a much more robust document that's going to help you in banks and in insurance and all sorts of wonderful ways. Kate, next slide, please. So the other thing that really came to be is the IFRS, who is responsible for setting global accounting standards, realized that with all of these disclosures coming down and the way accounting is going to be involved in a lot of these disclosures, we really needed to have an oversight body. So they basically built a whole division, the ISSB, that's going to be responsible for setting global sustainability standards. And they pulled in a lot of really great frameworks to really have really robust and harmonizing rules. And we expect the finalization of those rules also to happen this year. So a lot of stuff is coming out this year that's really going to kind of make this, like I said, no longer a need to have, but a have to have. Next slide, please. So the other thing that happened recently was the IRA, or the Inflation Reduction Act. And this injected a ton of money into climate and energy, a ton of money into domestic production of solar panel, wind turbines, batteries, as well as critical support for actually mining the minerals needed to build those things. I get asked a lot with this question, Jennifer, is this enough? Is this enough for the US to do to get us kind of even with what we've been needing? And while it's 40% below, it's a great first step, but we still need to do more work. So there's still a lot to be done, but for the US, this is a huge, great first step. So let's dig into the IRA and really look at some of the things that businesses can do as well as homeowners. Awesome, Kate. Thank you. So top 5 ways IRA can help businesses. Basically, it's more money in forms of credits and rebates. Some things got extended, some things got added. There's lots of energy efficiency and renewable energy projects that you can dig into for your business, like adding solar and a battery pack for manufacturers is so important, because then you can maintain your energy. You can run off your battery pack during energy surges to bring down your cost, or if there's some of those blackouts or brownouts that we typically get in the summertime, you then have the ability to shut down your production when you want to shut down your production, not when the utility company says so. So having that there and having that flexibility and that protection eliminates that risk for a business. Next slide, please. Some of the other stuff is new technology like clean hydrogen, alternative transportation fuels, and some extra consideration was given to domestic production and developing in low income areas, We do have a partner that we work with, a construction partner, Mint Systems, and let us know if this is something that you want to dig into for your business. We can bring them in and do an introduction so that they can come in and look at your operations and how to beef up the energy efficiency of your building. And this is good for people who own the buildings and as well as people who are leasing their buildings. There's great ways to have conversations with your landlords about energy efficiency for the entire building if you're just one tenant in the building, so that you can actually take advantage of some of this stuff. So let's switch over to homeowners. So homeowners, lots of great stuff. There is rebates for installing heat pumps. There's rebates for upgrading your electrical panel and improvements for the electrical wiring, all the stuff that you would need if you're going to install solar on your home. They really took a look at that and said, well, it's not just solar, it's all the things that you have to do in the home to upgrade it in order to hold the solar or put in a battery pack. Similarly to how businesses can leverage the battery pack, homeowners can too. And then insulating the house so that you can really make sure that your home is energy efficient. Next slide, please. The other thing is, I would say if you're going to be doing solar installations, get it in queue sooner rather than later. The NEM is the net energy metering rules are changing and will impact resident solar very soon. So get your stuff into queue before this stuff hits. So if you're looking to do it, call somebody soon and get that into play, and then we'll be able to put it on your next year's taxes, right? Or this year's taxes. So go ahead and switch to the next slide, please. Okay, now we're going to get into how we can help you. We have lots of wonderful tools in our toolbox. Next slide. So we have our basic approach where we come in and we assess where you're at in your business and organization. We have several different frameworks that we can use for this. Then we help you build a full implementation plan and break it down into bite-sized pieces and actions over time, and then help you develop a budget that's realistic so that you can actually get that work done. I know many companies, they really haven't thought too much behind a budget for it. Really, the only budget they have is for their sustainability or ESG person that's full-time on staff. And we want to make sure that they have all the resources they need to be able to get the job done. And then we help articulate a story. It is so important to articulate where you are in your sustainability journey appropriately. It's okay if you're not doing everything 100%. You don't have to be. You just need to communicate where you're at and your plans for where you're going. And your customers are really going to be excited to see that and support your brand. Next slide, please. So here are all the tools in our toolbox. There's so many different frameworks out there, and they all are great frameworks because it's all helping you look at your business in a new way to help you really eliminate risk first and foremost. So we've got the public facing stuff that's B Corp, science-based targets, climate neutral, really great public facing stuff that consumers look for these days. We're really good with certifying companies to become certified B Corps. I am specialized in that myself. And there's a lot of things happening in the B Corp world. B Lab, who is the oversight body for the B Corporation certification, is actually working with GRI, another entity to certifying framework, to really tighten up the guidelines and harmonize the two different frameworks. And so in 2024, they're going to be coming out with some new standards. So if any of you have been thinking about becoming a certified B Corp, once again, recommend you get on that sooner rather than later. Get your assessment in queue with B Lab before the end of the year. That way you're running off of this framework, which will help prepare you for the new framework, which is going to be, instead of 5 areas, there'll be 10 areas. And instead of 80 points overall in order to submit for your review with B Lab, it's going to be an exact point requirement in each of the 10 areas. So they're really going to make it a lot more robust, which is a good thing, right? And so that's coming January 1st, 2024 is when we expect to see those new standards. And they're rolling out more information about this, and we expect to have final standards sometime in September. So definitely keep a lookout on our blog for more information on that. And then we've got this other side, which is the shareholders and investor type frameworks that really give those folks the type of data they're looking for in the ESG and sustainability world. We have our Impact IQ, which we are the deployment partners for Impact IQ framework. And this particular ESG assessment gives you an internally generated ESG score, a statement, kind of like a P&L, but for sustainability, and a dashboard. So you can easily visualize where your low-hanging fruit is, what are going to be more long-term projects, so that you can really help tackle your sustainability goals. So next slide, please. So reach out to us, because we not only have our sustainability practice, but we have our accounting folks and our consulting side. So we can really put together a plan to help you integrate this into your business plan, into your operations. And you can think of us as your outsourced sustainability department, kind of like outsourced accounting, but outsourced sustainability if you need that leverage. And we do have a free ESG assessment offer going out. So keep an eye out for that. It's a free 30-minute call where we can come in, learn a little bit about your organization, and help guide you on what frameworks are perfect for what your goals are and are material to your industry. So if you're interested, please reach out. We've got our website right there. And thank you, and have a great day, y'all.
Thank you, Jennifer. I'm going to go ahead and send our next poll. Just launched. The question is, do you feel ready for the new SEC disclosures? The answer choices are yes, no, unsure, or not applicable. And you guys are quick on this one. 67%. Fabulous, almost there. About 75% precipitation. Cool. All right, I'm going to end the poll in 3, 2, 1. Looks like the majority of the people said not applicable. Second is unsure. Third is yes. And fourth came in last. Last but not least, we're going to go ahead and toss it on over to Ming to talk about international tax.
Thanks, Kate. Hello and welcome, everyone. My name is Ming, and I'm the Senior Manager at SSF that specializes in U.S. international tax. Today, I want to talk about the international tax system briefly on the high level. And later on, we will change topic to discuss a little bit on the compliance side regarding the common international tax forms one could see and want to pay attention to. At the end, we'll briefly talk about the new minimum tax regarding multinational corporation, which is called the book minimum tax, and is effective for tax year started in 2023 and after. So next slide, please. So in the worldwide system, regarding the, let's start our topic again, sorry. For the tax regarding international transaction, every country has their own rules. In general, there are 2 types of systems. One is worldwide system, which tax on its residents' worldwide income, regardless of where it is earned. The other one is territorial system, which tax incomes happens within its territory, and no tax on foreign income. However, most countries are not a purely worldwide or territorial system. For example, the US tax system fell into the worldwide system predominantly, but after the Tax Cuts and the Jobs Act back in 2017 and 18, it's moving towards a territorial hybrid system to follow its allies in Europe. And most of the European countries are on a partial territorial system. Next slide. So regarding the US international transactions, it's generally separated into two categories. One is inbound and one is outbound. I know they are pretty straightforward and it should be easy to identify. Inbound means foreign person investing into the US, such as foreign corporation opening a shop in the US continent. And the outbound means US person investing in overseas, such as a US citizen or corporation establish a foreign subsidiary. The distinction is different and important because inbound transaction is following territorial system that US only tax on certain US source income, and the outbound transaction is worldwide system that US taxes resident on worldwide income, unless there is exception. Next slide, please. So going back to the inbound transaction I discussed earlier, we will also need to determine the type of income in order to determine its tax rates. There are two types of income that will be taxable by the US. One is called the ECI, which is effective connected income. And the other one is FDAP, which is fixed, determinable, annual, and periodic income, which is a long name. Their definition and what income could be considered as ECI or FDAP could be complicated and confusing. But for simple explanation, and for example, one can think of ECI as doing business in the US, and it is taxable at a gradual rate like a normal income a US person normally see. And for FDAP, it's taxed at a flat 30% withholding tax rate, such as interest and dividend. And unless there is a tax treaty, there's going to be the tax treaty can be the exception to lower the tax rate for the withholding. Next slide, please. For outbound transaction, they were predominantly subject to worldwide income taxation for US residents before the Tax Cuts and Jobs Act. However, some income was allowed for deferral and not taxed until repatriation to the US, such as income from foreign-owned subsidiary. They were not taxed until it was distributed back to the US parent company. Foreign tax credit, which is tax paid to the foreign country related to the taxable income, was also allowed to reduce US tax amount. This caused the multinational corporation heavily invested in the foreign low-income jurisdiction to effectively lower its overall income tax. Then Sub-F regulation came into the place to prevent such deferral and forced the US parent company taking in the foreign income each year if they were involved in certain type of transactions that is not favored by the US government. The detail of Sub-F is very complicated and is not very applicable in this days and age, so I'm not going to go into details. And for post-Tax Cuts and Jobs Acts, the US has transitioned into a hybrid territorial system with a few provisions. By allowing participation exemption by form of foreign dividend received deduction, corporation with foreign subsidiaries is allowed to repatriate income tax-free as foreign dividends. And on the other hand, US remains to tax US company and the individual's foreign subsidiaries income if it is below certain tax rates through its global intangible low tax income provisions, which is famous for GILTI. The provision pretty much eliminated any tax deferral since it requires annual calculation and inclusion. The Act also enacted foreign-derived intangible income provision to help promote US export business and increases foreign revenue. And the base erosion and abuse tax provision, which is called BEAT, to discourage multinational corporations from avoiding tax liability by shifting profits out of the US and force them to pay its share of minimum tax. I know all this are pretty complicated, and please know that it's impossible to explain them in details in a short amount of time. So if you have any questions or concerns regarding to any of those above, please feel free to reach to us or send in your question in the Q&A box. Next slide, please. Okay, now so we are going to change gear and the focus to talk about the actual forms you will see when preparing the tax returns. The first one I'm going to talk about is the FinCEN 114. And then it's actually not a tax return form since it's submitted to a Bureau of Department to Treasury, but the IRS has authority to cross-examining its information. Any US person, if it has any foreign financial assets that combined value is over 10,000 USD, then one should think about the filing. And if you are an officer with a company and have signature authority of any of its foreign bank accounts, you should think about if you are required to file the FBAR too. Both US corporation and individual are subject to the filing. And there is no paper filing anymore for the FinCEN Form 114. One will have to go to the FinCEN website to submit it or through your tax preparer's software to submit it electronically. The regular deadline is 4/15, but it is automatically extended to 10/15 and nothing is required for the extension. Non-compliance penalty can be up to $100,000 or 50% of the total highest account balance combined, whichever is greater. Although in my experiences, IRS has not yet been very actively auditing or assessing penalties, one should not omit their filing obligation since the risk of penalties still exists and do not go away with time. Next slide, please. The next one I'm going to talk about is Form 8938. It's similar to the FinCEN Form 114, which require to report one's foreign financial assets also. However, there are some differences, even though it's always confusing which one is for which one. First, it's filed with the income tax return for both corporation and individual if one meets its requirement. So it's not filed separately to the Treasury. Second, is a filing threshold are different than the FBAR. As you can see, I've attached the filing threshold here to the slide. And you see it varies, depends on if the taxpayer is living in the US or not. And also it's based on the highest balance in the year versus the year-end balance. Third, the specified foreign assets definition is different than FBAR. For example, foreign corporation shares held directly by you is not reportable for FBAR, but is required for the 8938. There is no signature authority requirement for the 8938, so an officer of a company with foreign bank accounts is not required to be reported here. Next slide, please. The last form I'm going to talk in details is 5471, which is a very important form if one has any connection to a foreign corporation. Both entity type of returns, such as C corporation, or pass-through entity like partnership and S corporations, and the individual are all required to file 5471 if they are meeting definition of one of the categories of filers set by the laws and by the IRS. The guilty provision I mentioned earlier is reported using Schedule I-1 within the 5471 forms. And the FDII I mentioned earlier also could also use some of the information from here. The entire 5471 reporting is very complex and it requires a lot of information gathering, such as foreign subsidiary financial statements, including balance sheets and income tax statements. And the foreign country's tax return information is most likely needed. The end product is likely having to prepare another separate tax return, so it's very time consuming. It's part of income tax return filing, and the due date can be extended with the regular tax return extensions. The penalty for non-compliance is very high, as each 5471 penalty is at minimum $10,000. And if one have multiple 5471 filing requirements, like if they have multiple the foreign corporations, it could stack up quite quickly, as you can see. Next slide, please. For this slide, I'm going to briefly mention some other international tax form that one may see from their tax return preparation. I want to pay attention to if they have any of those transactions. 8833 is for tax treaty. If one person used treaty to modify the US income tax rule, this is where it should be disclosed. Form 2555 is for foreign earned income exclusion by expat working in foreign countries. So it allows certain earned income to be excluded from US tax. Form 5472 is for foreign multinational corporation with US subsidiaries to report transactions from US sub with their US tax returns. Form 8665 is similar to 5471, but it is used by US person with foreign partnership instead of corporation. 8858 is informational return for US person with foreign disregarded entity. And lastly, both the Form 3520 and the 3528 are related to the foreign trust reporting. Next slide, please. Okay, we have reached the end of my section, which is the current development and the news regarding international tax. A few months ago, Biden administration has signed the Inflation Reduction Act into the law, and they added a minimum tax to the international tax provisions for multinational corporations. It imposed a 15% minimum tax on adjusted financial statement income, which is so-called book minimum tax. It also applies to it only applies to corporations with average annual book income over 1 billion in a 3 tax year period. And if US corporate is a subsidiary of a foreign parent corporation, the US income will have to be more than $100 million to be subject to these rules. This provision is applicable for tax year started after December 31st, 2022. So it's not going to be in the 2022 tax return preparation this year, but the one we want to pay attention for next tax year, because if you have more than $1 billion, then you will be subject to these requirements. Next slide. So this is the end of my slides. So Kay is coming back to give you the lovely poll question to end this session.
Thank you, Ming. Here is your last polling question for the day. Question is, do you currently have any international tax exposure? Question options are yes, no, not applicable, or unknown. Fabulous. About halfway there. Almost 70%. There we go, 71. Give it about 10 more seconds. And I'm going to close it down in 3, 2, 1. So it looks like 21% of you guys said yes, you have international tax exposure, 38% said no, and 41% said not applicable. Well, that is all we have for you guys today. Thank you very, very much for joining us. We hope you found the information very useful. As a reminder, the slides and recording will be provided within 24 hours. If you have any other questions, please respond to that email, reach out to your relationship lead, or email info@ssfllp.com. Please have a great rest of your day, and we'll see you guys soon.